Tax-free savings account. If you're a working age Canadian, there's a pretty good chance you've heard that term a few times in your life, maybe from a financial advisor, an accountant, or even the financial media. A tax-free savings account is one of the two tax-free and/or tax-deferred accounts available to Canadians, the other being the Registered Retirement Savings Plan, or RRSP. But what is a tax-free savings account? On the surface, the term might sound confusing because you're probably not used to paying taxes on cash balances. Well, what a tax-free savings account is a little different from what the name implies. It's really more like a tax-free investing account, an account in which when you hold stocks, bonds, or funds holding stocks and bonds in it, you pay no taxes on the returns. That raises another important question. Exactly which taxes does a tax-free savings account make you free from? I previously mentioned investment income. Does that mean that if you have a tax-free savings account, you don't have to pay property taxes on rental properties you own? Can the tax-free savings account reduce your employment taxes? Can it reduce taxes on an unlimited amounts of stocks and bonds? In this video, I'm going to explore exactly which taxes the tax-free savings account spares you and which ones it doesn't. By the way, if you're an American, make sure to hit the subscribe button because in my next video, I'm going to be covering the Roth IRA, which is the American tax-free account most comparable to Canada's tax-free savings account. To explain what a TFSA is, it helps to start by comparing it to an RRSP, another tax-deferred account that Canadians are familiar with. In this case, having been around longer than the TFSA has, meaning that more people understand how it works. An RRSP is called a tax-deferred account because it defers your taxes on anything held within it to a later date. The way it works is you deposit money into your RRSP. That money, provided it's within your contribution limit, is then treated as an expense on your income taxes. So the RRSP does reduce your income taxes. Additionally, your investments within the RRSP are free to compound tax-free until the time that you go to withdraw. The downside with the RRSP is that when you go to withdraw, the funds, as you withdraw them, are then immediately taxed at your marginal tax rate, meaning the tax rate you pay on an extra dollar of income. Now, the RRSP has been used by Canadians for many decades. The TFSA is newer. It works a little bit like the RRSP in that investments are allowed to compound in the account tax-free. The difference is that with the TFSA, there is no tax break on contribution, so it doesn't reduce your income taxes, and there's also no taxes on withdrawal. So the TFSA is more useful for, say, short-term savings or savings that you intend to cash out of later and use to spend before you retire. Now you might be thinking, great, so I can just use my TFSA to never have to pay taxes on investments ever, right? Wrong. The TFSA has many different account rules governing it, and they restrict what you're allowed to hold in it. So, for example, you're not allowed to hold real estate investments in your TFSA apart from publicly traded ones like REITs, which means, unfortunately, those property taxes are going to have to keep being paid. What you're allowed to hold in a TFSA is liquid, publicly traded securities in companies that you don't control. So, for example, stocks, bonds, and index funds made up of stocks and bonds would be considered eligible investments for your tax-free savings account. However, you're not allowed to hold unlimited amounts of them. There's a contribution limit, which is based on the amount of TFSA contribution room that is added each year after which you turn 18, on or after which you turn 18. If you were 18 or older in 2009, that means you have $88,000 worth of TFSA contribution room accumulated by this year if you've never opened and contributed to a TFSA before. If you were younger, the amount will be lesser than that. Now, next year, there's going to be an additional $7,000 worth of TFSA contribution room added, which means that the total accumulated contribution room for those who were 18 or older in 2009 will be approximately $95,000. What kind of investments should you hold in a TFSA? In general, it's best to use TFSAs for long-term savings because if you put a short-term investment, let's say a GIC, that you're using to save up for a purchase into a TFSA and then withdraw it, that sum is taken off your contribution room and you can never get it back. Additionally, there's differences in terms of how much taxes you are saved based on different types of securities. A stock that does not pay dividends that you plan on holding for your entire life, let's say Berkshire Hathaway or Google, may not be the best candidate for a TFSA because you may never pay taxes on it anyway. Dividend stocks and interest-bearing bonds are generally thought to be good candidates for TFSAs because they produce taxable income that comes in every single quarter, sometimes every month, whether you want to cash out or not. Between the two, if you have to make a choice, it's best to hold interest-bearing bonds in a TFSA because interest has a much worse tax treatment than dividends in Canada. When you receive a dividend payment from a dividend stock, you pay a tax that is essentially your marginal tax rate times the amount of dividends you received minus the dividend tax credit. With interest paid from a bond, you simply pay your marginal tax rate on the amount received with no credit. So if you have a full $88,000 worth of bonds and you have another sum that you want to hold in dividend stocks, it's best to use the TFSA strictly for the bonds because you save the most amount of tax dollars on interest-bearing bonds inside of a TFSA. As a concluding note, I should try to dispel a common myth about TFSAs, which is that you can never be taxed on assets held in a TFSA. In fact, you can. If you somehow break the TFSA's account rules in what you put in it, then you will in fact be taxed. For example, by over-contributing, you will pay a 1% tax each month on every dollar in excess of your contribution limit. If you put shares in a company that you control inside of a TFSA, you will also be taxed if the CRA catches you doing it. And last but not least, if you are day trading inside of a TFSA, the CRA might find you doing that, determine that you are running a trading business, and decide that this is business income, not investment income, and tax you accordingly. The day trading thing in particular has gotten a lot of Canadians in trouble. There have been many cases of full-time traders holding sums in their TFSAs, day trading full-time as a job, and running their account up to over $1 million and being taxed on all of it. The real killer in this situation is that the taxes you pay are even greater than the taxes you would normally pay on investments, because if the CRA determines that you're running a trading business, then it's considered employment income and you pay your full marginal tax rate on the money that you made. That's a lot more than you would normally pay on a dividend or a capital gain. So there you have it, the tax-free savings account. What it is, what it isn't, what taxes it spares you, and which ones it doesn't. If you like this video, leave a like. If you have any questions, leave it in the comments below and I'll try to get to all of them. And if you're American, don't feel left out because shortly I'll be putting out a video on Roth IRAs, which is the US equivalent to the tax-free savings account. Anyway, that's it for me. Happy savings.